What we just witnessed was not a market correction. It was not a sign of fundamental weakness in the underlying asset class, nor was it a natural, organic capitulation of speculative excess. To use the vernacular of the battlefield, what occurred over the last few trading days was an act of deliberate, visible, and highly desperate market coercion. It was an ambush, the official narrative disseminated quickly through the financial press and the institutions that benefit from suppressed prices. Attempts to frame this event as a natural symptom of market fatigue or a necessary cooling-off period. They tell you it was merely excess speculation being wrung out. That is the cover story. That is the lie. Our central thesis is the opposite. This was not weakness. This was the ultimate offensive maneuver by the controlling entity, a final, visible gasp of desperation, intended to maintain the illusion of stability and control over a market they have already lost. They are deploying their nuclear option to protect the perceived integrity of the financial system, which is fundamentally based on debt and fiction. To understand the attack, we must first delineate the battlefield. The market is fundamentally bifurcated into two distinct, separate realities. First, you have the physical reality, the finite, tangible market of actual metal, the industrial demand, the sovereign storage. The bars and coins held by those with strong hands and generational conviction. This market is immutable. It is defined by physical scarcity, and crucially, it is immune to technical manipulation executed by banking desks. Second, you have the paper construct, the massive leveraged and hyper-derivatized futures and options market. This construct is not about physical ownership. It is the arena where financial fiction is created, where illusion is maintained, and where the controlling entity holds its primary weapon. The system possesses what we must accurately call the kill switch. This is the ultimate regulatory hammer, operationalized primarily through the margin requirement and the sudden force of regulatory edict. It is the tactical option they deploy when they are faced with an overwhelming physical reality they cannot manage through simple short selling alone. The strategy is simple but brutal. Impose drastic sudden technical adjustments by dramatically elevating margin requirements overnight. This action has nothing to do with prudent risk management and everything to do with coercion and force. It mandates instantaneous liquidation across the entire leveraged spectrum. It ensures that funds holding positions, the weak hands who are attempting to profit from true price discovery, are automatically forced out of their leveraged holdings, regardless of profit or loss. This creates an artificial tidal wave of selling pressure, designed specifically to generate maximum psychological panic and shatter market confidence. This is how they attempt to force the price back down to a level that keeps their paper balance sheets intact. This isn't speculation. This precise maneuver, this utilization of margin requirements as an extermination switch, is not novel. It is a standard operating procedure, tested and proven in the past. We only have to look back at the historic event of 2011. That playbook was executed flawlessly. Back then, it worked. The sudden, forced selling successfully quelled the physical buying frenzy, shattered investor confidence, and drove the price back down into the controllable range for nearly a decade. But here is the critical difference. This time, their attempt at historical suppression failed. The familiar blueprint produced a radically unfamiliar result. Why? Because the underlying structural architecture of the market has undergone a fundamental, irreversible transformation. The environment in which they deployed their margin weapon is no longer the environment they controlled in 2011. The demand base has fundamentally shifted. In 2011, a large percentage of market interest was speculative, driven by short-term traders relying heavily on leverage, the very definition of weak hands. Today, the global demand is sovereign, industrial, and increasingly based on outright equity ownership. It is inelastic. It is capital that is immune to margin adjustments. You cannot issue a margin call to a sovereign mint or an industrial end user who needs the metal for their supply chain. You cannot coerce liquidation from someone who holds the physical asset free and clear in their vault. This current demand is composed of strong hands, and the margin weapon is utterly inert against them. This is the heart of the current battle. The antagonists are wielding a paper weapon, the mechanisms of leverage and margin manipulation, against an unyielding physical reality. This reality is defined by inelastic industrial demand and a deep structural supply deficit that cannot be wished away by algorithms or regulatory pressure. Their sophisticated leverage game is completely useless against this current target. They can crash the price on the paper exchange, but they cannot manufacture a single extra ounce of metal to meet the true deficit. That is the point of utter strategic failure. The battle is playing out as a definitive war between an infinite supply of paper contracts and a finite, shrinking supply of metal. The paper price can be controlled, but the physical supply chain cannot. This is why the latest, most aggressive attempt to crush the price merely succeeded in creating the perfect bear trap. The forced liquidations, the engineered panic, resulted not in a sustainable correction, but in an aggressive and artificial transfer of wealth. This maneuver is not new. It is, in fact, the standard operating procedure for the control entity. We have historical precedent for this precise strategy. If you want to understand what the playbook is supposed to achieve, you only have to look back at the beginning of May 2011. That was the last time the price of silver attempted a genuine structural breakout above $40. The regulatory apparatus stepped in. increasing the margin requirement not once, not twice, but 5 times in 8 days. The effect was instantaneous and devastating: massive forced liquidations, a complete collapse of speculative enthusiasm, and a return to the price regime preferred by the centralized planners. It worked then, and it worked spectacularly well. But there's a fundamental reason why the latest iteration of this attack has failed to achieve its strategic objective, despite achieving maximum tactical violence in the paper market. The structure of ownership has changed irrevocably. In 2011, the market was dominated by leveraged speculators, what we call the weak hands. They were trading paper, futures contracts, chasing momentum, and utilizing high degrees of leverage. When the margin hikes were imposed, the weak hands were obligated to liquidate to meet the new capital requirements. They were forced sellers, driven by technical necessity and psychological panic. The weapon was extremely effective against that target profile. Today, the target profile is sovereign, institutional, and industrial. These are the strong hands. The massive demand now entering the market is not based on leverage. It is based on balance sheets. It is based on unhedged industrial necessity. It is based on national strategic reserves that must be built, regardless of the daily paper price volatility. Against this cohort of buyers, the margin weapon is completely inert. You cannot force the liquidation of an institution that is buying physical metal with cash, taking it off the exchange, and putting it into storage. You cannot coerce a solar panel manufacturer, whose future growth depends entirely on securing tons of the metal, into selling their inventory just because the price temporarily drops on a paper exchange thousands of miles away. The battle is no longer between bulls and bears. It is a war between the infinite paper construct and the finite physical reality. The manipulators can raise the margin requirement to $1 million per contract, and it would not change the fact that global industrial demand is outpacing supply by hundreds of millions of ounces annually. Their strategy is completely useless against the structural deficit. This is why the engineered collapse did not produce the correction they desired. The forced liquidations were instantaneously and aggressively monetized by the shadow order book. As soon as the weak hands were compelled to sell their paper positions at a loss, the strong hands, the entities who desperately need the metal for physical reality, stepped in and scooped up every single ounce equivalent. The only effective result of this massive effort to suppress the price was the purging of the leveraged speculators, transferring their remaining control over the metal into the custody of the most convinced, most patient, and most inflexible holders in the world. The manipulators thought they were setting a trap for the silver market. Instead, they built the perfect bear trap for themselves. They succeeded only in establishing an ironclad price floor, while accelerating the consolidation of the physical asset into hands that can never be coerced into selling. The immediate consequence of this regulatory offensive was exactly what the control entity intended: a sudden and aggressive transfer of paper wealth. The weakest links, the highly leveraged funds using borrowed money to speculate on price movement, were instantly liquidated. They were purged from the system, but this purging was not followed by the collapse the antagonist desired. In fact, what followed was a vacuum filled instantaneously by the silent buyers. These are the powerful institutions, the sovereign wealth funds, and the global industries that operate on an entirely different time horizon than the average trader. They do not trade silver, they accumulate it. They saw the sudden artificial dip in price as a gift, a momentary discount offered by panicked speculators forced into a fire sale. They swept the entire board clean. This swift absorption of selling pressure cemented the most significant technical pattern of this entire saga: the perfect bear trap. A bear trap is defined by a false signal of a market breakdown, luring those who short the asset into overly aggressive positions, only to see the price floor hold firm and reverse sharply. The manipulation successfully drove the paper price down, confirming to the mainstream financial observer that the rally was over. They were baited into selling or shorting heavily, confident the exuberance had been checked by the heavy hand of regulation, but they were selling directly into the hands of buyers whose demand is inelastic, whose need is purely physical, and whose capital is sovereign. The downward momentum was a total illusion. It was absorbed by an invisible order book that operates outside the public view, establishing a new rock-solid price floor that is now structurally higher and fundamentally more robust than anything we had before the attack. Consider the immense irony. The control entity, desperate to stop the price breakout, utilized its ultimate weapon, the kill switch of margin requirements, only to achieve the exact inverse of its objective. Their massive, centralized, and coordinated attempt to create maximum psychological panic served only to accelerate the drain of the physical asset out of their custodial system and into the hands of unshakable long-term holders. They expended their most powerful ammunition to cleanse the market of the very speculators whose paper positions provided the illusion of supply. The short-term pain inflicted upon the leveraged funds resulted in the long-term permanent consolidation of control into hands that will not, cannot, and structurally do not need to sell. The battle for the paper price cost the antagonist dearly, confirming that their control over the futures market is rapidly reaching its point of exhaustion. This was their final, visible, conventional defense, the ultimate exercise of the paper weapon, and they lost the asset itself. The battle for the paper price cost the antagonist dearly, confirming that their control over the futures market is rapidly reaching its point of exhaustion. This was their final, visible, conventional defense, the ultimate exercise of the paper weapon, and they lost the asset itself. The question now shifts from what they can do, to what desperate action they must take. With their conventional ammunition spent, and the physical supply draining faster than ever, the antagonist is cornered. They have one remaining power, the direct exercise of regulatory force. This is the nuclear option, and its deployment will signal the definitive surrender of their market control. We must anticipate measures that are overtly hostile and completely non-market based. Think about extreme position limits designed to force massive selling from successful traders who are holding too much physical exposure. Think about imposing liquidation-only status, meaning you can sell your contract, but you are barred from establishing any new long position, effectively closing the exchange to buyers. These desperate maneuvers are not designed to reassert control over the price. They are designed purely to deny delivery and slow the terminal momentum of the physical squeeze. But here's the irony. The strategic checkmate. Any escalation of regulatory warfare constitutes a public, visible admission of guilt and failure. If they must intervene with explicit rules to prevent market participants from exercising contractual rights, if they must arbitrarily limit who can buy and how much they can hold, they are confessing to the world that their system is rigged, broken, and incapable of price discovery. This admission guarantees the Great Decoupling. The moment the centralized exchange resorts to such non-market coercion, the price discovery mechanism migrates immediately and irrevocably. It moves to the physical over-the-counter markets, the industrial supply contracts, and the direct dealings between refiners, sovereigns, and mints. This market operates entirely outside the regulatory perimeter of the exchanges. It is purely supply versus demand, based on tangible metal, not leveraged promises. Once the price is discovered off-exchange, the fiat price quote becomes instantly irrelevant. A fictional construction maintained only by the central banking entity and ignored by anyone needing actual metal. The desperate act of regulatory intervention will not save the antagonist. It will accelerate their collapse. It transforms the physical price into a runaway train, disconnecting permanently from the paper caboose that they desperately cling to. When they implement the nuclear option, they will be confirming the fundamental truth. The paper price is a lie. This final, frantic defense will pave the way for the rapid, permanent ascent of the physical price to its true value. What we just witnessed was more than an attempted market correction. It was a final, desperate test of conviction engineered by a cornered entity. Did you panic when the paper floor dropped out, or did you understand the fundamental mechanics at play? Your decision to hold the physical metal, your refusal to participate in the leveraged paper illusion, meant you passed the ultimate stress test. The system, through its absolute worst at its maximum financial coercion and psychological warfare, it failed utterly to dislodge the core holders. The structure of the market is now coiled tight, prepared for a resolution that will be far more violent and swift than most can imagine. We are positioned for what is technically and mathematically guaranteed to be a massive short squeeze. The antagonist has used every ounce of regulatory and technical muscle to suppress the price, trapping themselves into unsustainable short positions that dwarf the annual production of the metal. These positions are leverage obligations, and they must eventually be closed. They must cover their paper short, in a world where every available ounce of physical silver is now residing in strong hands. There are no weak sellers left. The speculative float has been completely expunged. The moment the manipulative entity loses control, or the moment they are forced to honor the massive obligations they have incurred, the price will not walk up, it will launch. It will be a vertical, gap-up resolution, catapulting the price not just to the level it was before the attack, but far beyond the fictitious ceiling they tried to impose. But we must be precise about what this inevitable ascendance truly represents. We are not talking about a simple appreciation of a commodity within a stable financial system. This rise is the great repricing of value in the context of the accelerating collapse of fiat currency stability. The price of silver and dollars is not going up. The intrinsic purchasing power of the dollar is finally being exposed and recognized for the debt-laden promise that it is. The Exeter's pyramid is collapsing before our eyes. When the higher tiers of paper, financial stability from derivatives to over-leveraged banks and sovereign bonds fail, the vast reservoirs of wealth stored there must flow down to the only safe, tangible floor remaining. Physical metal, silver, being the most strategically drained and monetarily suppressed asset in history, represents the deepest discount on real value available today. Focus only on the fundamental truth. The math underpinning this market is simple and absolute. Infinite debt creation versus finite physical supply, meeting an irrevocable surge in industrial and sovereign demand. This combination guarantees the ultimate outcome. You are holding the exit ramp from a doomed currency system. Your primary mission now is persistence. Ignore the momentary price noise, ignore the final frantic attempts at psychological manipulation by the dying entity of control. They are throwing ghosts onto the charts to scare you out of reality. You are holding reality itself. Maintain your position, hold the line, the battle for price discovery has been won. The countdown to true revaluation has officially begun. The structure of the physical market is now engineered for one outcome: a violent resolution. Understand that the current setup guarantees a massive short squeeze, not merely a modest price correction. This is the mechanical reality when years of artificial suppression, executed through infinitely leverageable paper contracts, finally meet the brick wall of finite physical supply backed by sovereign and industrial necessity. When the paper contracts are rendered inert, or when the cost of maintaining the short position becomes mathematically fatal, the price will not crawl upward. It will be catapulted far past any previous perceived high. This move will happen with unprecedented speed, defined by the immediate necessity of industries and governments to secure the physical commodity required for existence. Once that critical moment of decoupling is universally recognized, the time to buy will be gone. The window of accumulation, which the entity of control fought so desperately to prolong with their final bear trap, is slamming shut. This brings us to the ultimate paradigm shift, and this is the core truth you must internalize. The inevitable ascent of silver is not just an asset appreciating, it is the real-time, instantaneous repricing of value in the context of a total currency collapse. When we talk about silver hitting extreme price targets, we are not predicting a massive increase in the intrinsic value of the metal. We are predicting a massive, terminal decline in the purchasing power of the US dollar, and all fiat currencies pegged to it. Silver is merely the barometer of that destruction. It is the measuring stick that refuses to shrink. The dollar is entering terminal velocity, driven by irreversible debt loads and inflationary policies that have long passed the point of no return. In this environment, the concept of price measured in paper units becomes meaningless. What matters is stored labor, stored energy, and stored survival value. This is where the physical asset, specifically silver, the irreplaceable cornerstone of modern electrification and technology, becomes the only safe floor left in the collapsing pyramid of global debt. The fight is over. The manipulation was their final, desperate gamble, and it served only to confirm their weakness and accelerate the transfer of wealth from weak, speculative hands into the strongest physical hands. They confirmed the trap, secured the foundation, and ensured that when the physical supply truly runs dry, the resulting price discovery will be instantaneous and unforgiving. Your conviction is your greatest weapon. You hold a finite asset in an infinite debt system. You hold the hard, technological truth against a mountain of financial fiction. The countdown to true revaluation is not measured in days or weeks, but in the rapid and inevitable failure of the construct they are trying so desperately to hold together. Prepare for the violence of the resolution. Prepare for the moment the paper market vaporizes and reality asserts its dominion. Silver will not just reflect the panic. It will be the physical exit from it. The recent ambush was not a setback. It was the final, brutal examination. If you maintained your physical position through that synthetic chaos, if you ignored the fabricated panic and the psychological warfare, you passed the test of conviction with flying colors. You demonstrated that your position is built on the reality of supply and demand, not on the fragile faith of the paper casino. This entire operation, designed solely to instill maximum fear and shake out the weak hands, served only one mechanical purpose: to compress the spring of potential energy even further. We are now mechanically set for the most violent resolution possible. The short positions in the silver market are not speculative bets. They are monuments of outstanding fraud, held up only by regulatory distortion and the desperate power of the clearinghouses. When that structure finally gives way on, it will not be a slow erosion but an immediate, catastrophic failure. The ensuing short squeeze will not register as a typical price rally. It will be an explosion, a violent correction where price is catapulted beyond any conventional analysis. Understand what this great revaluation truly signifies. When we discuss silver moving to 3 digits, or multiples of that, we are not celebrating simple asset appreciation. We are witnessing the necessary and brutal repricing of value against the backdrop of a catastrophic currency collapse. This is the paradigm shift. The debt system that underpins the current financial order is structurally infinite. It relies on the perpetual creation of fictional purchasing power. The physical supply of real, hard assets is finite. As the global confidence in unlimited debt vaporizes, the flight path leads directly and irrevocably to the finite. Silver is the technological, industrial, and monetary truth that the fiat system has attempted to suppress for decades. The higher its price climbs in nominal terms, the louder the fundamental collapse of the paper pyramid echoes. Your sole focus must remain anchored to the fundamental truth: irrevocable industrial demand meeting a rapidly depleting supply, all denominated in a currency that is consciously and aggressively being destroyed. Ignore the noise. Ignore the desperate, sputtering attempts by the controlling entities to distract you with transient price movements on a manipulated exchange. They are throwing dust in the wind, spending the last reserves of their credibility to maintain an illusion that has already failed. The physical market has already spoken. They cannot create more silver, but they must create more debt to survive another 24 hours. Stay physically anchored. Remain disciplined. Hold your position. Because when the music finally stops, when the great pyramid of paper collapses under the weight of its own internal fraud, silver will not just reflect the panic. It will be the only safe floor left in the rubble. We are no longer waiting for the market to fail. We are merely witnessing the final, inevitable steps of its process. The time for fictional stability is over. The time for physical truth has decisively arrived.